It's 2025, and Canadian natural gas is a once-in-a-lifetime opportunity. We have seen so many things line up perfectly with things like LNG Canada coming online, with massive geopolitical tension, with massive demand for more energy, and with a country finally looking to invest in its energy infrastructure that makes these companies some of the best investments you can make this year. But when you're looking at a whole sector like this, sometimes you have to ask the question, what is the best stock in this industry? Well, today I'm going to talk about two of my personal favorites in this industry. We're going to put them head to head. I'm going to talk about some numbers. I'm going to talk about their strategies. Finally, I'm going to tell you which one of these companies I would buy myself. Today, we're talking about Canada's best natural gas stock, and we're comparing Tourmaline and Peyto. Now, if you know these companies a little bit, you might think this is a weird comparison, but stick with me because I will explain why I'm looking at these two companies, why their strategies are a little different, and why maybe a different kind of investor might be really interested in either or. So to start off, let's talk about exactly what these companies do. If you don't know them, I have made videos on both companies. I will put those links in the description below, but they're both Canadian natural gas producers. They operate in that Western Canadian basin. We're talking Northwestern Alberta. We're talking Northeastern British Columbia. Obviously, this area is super well known for energy production. It's got a massive wealth of natural resources, actually dramatically more than they had expected. And both of these companies are massively profitable and looking to expand that in 2025. They both stand to benefit from the exact same trends in the exact same industry. They sell basically the same product. The difference is really in size. If you know these companies, you already know this, but Tourmaline is dramatically larger than Peyto. We're talking a market cap in the range of 25 billion for Tourmaline, right? Depending on obviously the market trends and all this. Peyto, we're talking like 3. So low single digits compared to mid 20s. Obviously that scale is going to benefit Tourmaline, but in this comparison, I'll tell you why maybe a different investor might be interested in a much smaller company in this industry compared to a much larger one. Now, obviously, you can't compare a stock like this without talking numbers. And to do that, there's no better way than for me to show you guys the FinChat home screen for these companies. We're going to start here on Tourmaline because they are the bigger player. We're going to start with price. Sitting today, as I film this, $70 a share. Pretty great. PE ratio, trailing 12 months, 19.4. Now, immediately, I can hear some value investors about to click off this video. But stick with me because like I've said, this industry is poised to grow dramatically. And one of the things that we've seen, specifically when we talked about Birchcliff earlier in March, was that these companies have dramatically revised their earnings estimates for 2025. Thanks in part to that, when we look at the next 12-month PE, just below that, we see it drops to 10. And that's with analysts expecting a price target of 79, which obviously represents $10 a share gain. Now, $10 a share over a year is nothing to, write home about, but that PE at 10 would be. That is incredible. Now, let's look over at some growth numbers because everybody here cares about the growth. Revenue growth, 5-year. I'm going to stick with the 5 years here because I feel like that's a good medium to long-term hold. That's the kind of period I would be interested in. Looking at almost 19%. I feel like we can round that up for them. 18.9. That's basically a 19% 5-year compound annual growth rate. Diluted EPS, 24.4. So again, I've talked about how this year they're expecting some fantastic earnings numbers, but obviously they've been growing their EPS year on year on year. If you look at the revenues over the forward 2 years, so the next 2 years, they're expecting 30% growth. EBITDA, 30% growth. EPS, 42. Okay, 41.9, but again, give them the roundup here. 42% growth. Really great numbers. The dividend, they're paying out a 5.5% dividend, which is great. 5-year growth on that is almost 25. 23.5, but the last 3 years have been even better. So pretty good numbers. So a dividend investor can be happy. A growth investor can be pretty happy. Only person that might not be super pleased with this company today might be a value investor if you're looking at last 12-month numbers, because obviously 19% PE, or sorry, 19x PE is not what you want to be looking at if you're thinking from like a strictly value perspective. But if you're somebody who likes growth at a reasonable price, I mean, this is a pretty great offer. And again, this industry is really set up for a seismic shift. Talked about it a couple times. And I know people are so down on the Canadian energy industry because of all of the drama, but I seriously think it's an opportunity right now. Now, speaking of opportunities, obviously Tourmaline is the much larger player here, but they're also the largest player that is sort of the, name brand natural gas. And I think that means there's extra value here. Now, I don't know how I would quantify this when I'm going to put this up against the numbers, but being the scale player in a growing industry where all of a sudden there's a lot of big money looking to maybe make an entrance, I think there's real potential for them to outgrow the competition, to out-acquire the competition, and just fundamentally outspend the competition in 2025 and going forwards. Now, obviously, $25 billion is not huge in the global scale compared to global energy giants or even to some global money that might be looking to invest. But in Canadian natural gas, they're much, much bigger than all the other fish. And that might be an opportunity we're not seeing reflected in valuation. Just putting that out there. Now let's jump over to our other company today, Peyto. Now, Peyto, like I said, much, much smaller company. So we're looking at some smaller numbers. We're looking at a price today, $18 a share, which puts us at a PE of 12.7, which is obviously much, much lower. Now, again, last time we talked about trailing 12 months PE, and then we showed you next 12 months. Well, look at this. Look at this number that we're seeing analysts project here. They're projecting a next 12-month PE at 6.9x. That's fantastic. That as a PE ratio, that's pretty great. Price target is 18.9. So maybe you're saying analysts are underestimating price growth. I mean, we've seen some fantastic price growth really, really short term. But I mean, we can argue either way, but giving them the same, equal weight here, that PE ratio looks even better than Tourmaline. Now let's jump over to growth, because obviously the story here isn't going to be quite the same. Otherwise, you'd be seeing a much higher PE ratio. We looked at 5-year growth last time. We're going to look at 5-year revenue growth this time, 13.5. Now that's dramatically lower than the almost 19 we talked about last time. But it's still, I'll call it mid-teens. Maybe you're going to say low teens. But that's still pretty good. Diluted EPS 5-year growth 11.9. Definitely low teens, right? I'd even say like low double digits. So not quite the same, but here's some numbers that you might really love. We talked about EBITDA forward, 21.5 on this company, revenue forward 15.7, but the big one, I'm sure you see it, EPS forward 2-year, 41%. Again, forward-looking numbers. You can say, hey, this is just a guess. Right? It is an estimate. It is an analyst's best guess. But 41% EPS growth? Come on, that's pretty fantastic. Again, we've talked about the Birchcliff model in this industry. I think they're going to surprise to the upside. If they haven't revised by the time this video goes out, I think they might. Dividends. Talked about dividends last time. Different story here. I want to, different story. 8.1% yield. Fabulous. Who doesn't want an 8% yield, right? There are dividend investors that would, crawl over glass for an 8% yield. Payout ratio of 92%. Now, all of a sudden, I've lost the dividend investors, right? So obviously, dividend investors don't love huge payout ratios. A lot of growth investors don't love huge payout ratios. But with growth the way it is, right, with those earnings just flying to the upside, maybe they're okay. Because obviously with the EPS numbers looking so much bigger, the earnings number looking so much bigger, free cash flow number presumably being a lot bigger, you might see that payout ratio drop significantly. Now the growth numbers on the dividend are just insane. 5-year growth of 40%. Insane. Not something you can sustain, as is made very, very evident from the payout ratio. It's actually, I know I'm not trying to talk about 3-year numbers here because I said I wouldn't do that, but 116% 3-year DPS growth, dividend per share growth, is fantastic and is fabulous. And again, is unsustainable. And so we come down to the question, right? Like, what is the best natural gas stock in Canada? And which of these two stocks do I think is a better buy based on the numbers, based on sort of the story, based on what I know about the companies, and based on what I'm looking for? And I could give you the bad answer, right? Or the cheesy answer of depends what you're looking for. But in all honesty, I love both of these companies. I think they're both great, and I think they present different opportunities. As somebody who is a dividend growth investor, Peyto offers a fantastic yield up front. They have a great management team. They have some incredible low costs, which means they are very, very well hedged and protected against downside. I love that. Tourmaline, like I mentioned, it has the X factor. It is the scale player. It is maybe a little overvalued right this second, but it has been a reasonable value recently. It will be a reasonable value in the future. And I think it might be the right answer. And I know it's boring to pick the biggest company in the industry and say it's the best one, but they can grow faster than any other company. So to answer your question, for my envisioned future scenario where I see this industry growing rapidly, where I see investment flowing into this industry, where I see real positive growth in Canadian natural gas, Tourmaline is the play. But if you're a dividend investor, or if you're not as bullish on this industry as I am, you should seriously look at Peyto, because they can weather just about any storm. They are hedged amazingly well. They are in a great position to deal with basically any natural gas price and just continue returning value to shareholders. And again, 8% dividend yield is nothing to sneeze at. That's about all I have for you folks today. I hope you enjoyed the video. Let me know, what other companies would you put on the list? I know there's a million fantastic Canadian energy companies on there. Maybe I'd love to compare some that you think would be a reasonable comparison based on, recent events or their size or any of those things. And of course, there's a million really interesting Canadian energy companies that we're going to talk about. I promise I will dive into a couple more. I just really wanted to talk about these two that I've talked about on the channel head to head. That being said, if you enjoyed this video, you made it this far, please do like the video, subscribe to the channel. It makes a huge difference and it doesn't cost anything. And with all that being said, I will see you in the next one.